Hey everybody, welcome back. Well, 41.85, I'll take it. For once, we didn't make a lower low, and it's been about 4 or 5 days. Actually, right here was the first, and you just count them off. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So 2 higher highs out of 10 days is not something that we're going to get all excited about, but this is definitely something that we have to talk about. We can see this little line drawing down here, and we're going to discuss this in some detail, but we have to talk about a lot. There's a lot going on here. If we take this level right here and just kind of come up there, it kind of fits in here, but I'm not really crazy about that, because if you clone them for a minute and you come up, you're not really fitting to something of substance. So I'm not really crazy about the way that that's sitting. So that gives me another steeper curve, and I want to show you this. So the first curve that we have is here. And what we don't like when we have these curves is we don't like when they fan. In other words, when the trajectory gets smaller and smaller. See that? That doesn't make us feel, as we like to say, warm and fuzzy. But if I take this one and I clone them, and you should always clone them because that determines the trajectory of the move, and you drop it in here, you're going to notice a couple things. So let's come right to there and drop that in. We can actually extend this out to about here. Perfect. So you can see the low of that, at least it kind of ties in there, but 1, 2, 3, 4 tying into that one. There's your channel. So what did you do? Well, you bounced off your lower channel. All right, so we know that this as a channel, if we were to come here and just clone that one and just drop that bad boy in and say, does that go anywhere? Well, yeah, it kind of does. It kind of fits right in here. And if we come back to that level right there, we can see that one. So if we just take a second of our time and pull that one out and go, well, yeah, this was our channel, and then we finally did what here? Well, we broke that channel. Okay, so if we know that we broke that channel, then the next thing that we would probably want to be aware of is the trajectory of the channel has gotten worse. So that means our situation has not gotten better, it's gotten what? Worse. It's not turning up, it's getting worse to the downside. So are we setting up for possibly to rally up and then break this channel? That's kind of where my head is right now. I have not seen anything come out on the earnings front that's going to change that. Now, what is bothering me more than anything is what's going on in the bond market. But before we even get there, we're just going to spend a moment here, and I want to get into this. And just so everybody has this basis, and we have a lot to get into. We have to get into AMD, what to expect tomorrow night. I've got a lot of detail from a research house I want to go through with you. We need to understand the Japanese bond trade and what exactly is happening there. I know everyone's really excited to hear about Japanese bonds, but it's what put the high in July 27th, and they're making more headway, so we're going to have to talk about that. But see this trend right here? So you can say, okay, well, we bounced off the lower trend. It's a start. Maybe it's a start. This is what's bothering me. We went from oversold here to overbought already. We're already overbought. Overbought at this level. Let me just click this button real quick and I'll show you. So that we stay there, and then here's overbought. Here's overbought. Do you see my issues? These are my issues. That this is what overbought looks like. So when we see it, we shouldn't be shocked that we're seeing overbought. But I'm legitimately shocked that we're already overbought on RSI. And that's a problem. Now, when you're oversold and you have these positive divergences like you do here, you don't know. You can see that. I'm sure that, if you've been watching this long enough, there's a positive divergence. And then you can see how you're acting right here. And someone would always say to me that if they worked as well as gravity, then we would all believe in them. And it does make me laugh. I have a graph on that, but I don't have time to pull it out. So this is where we're at right now. We have a lot to go over. All right, so overbought. Okay, well, that does not make me feel warm and fuzzy. So what are we going to do about that? Well, we're going to drill into this a little bit more. Wow, I could really use all those graphs today with the vernacular I'm throwing out there. Now, number one, we did not make a what? We did not make a lower low, even though the market did, okay? Well, that gives me a what? Positive divergence, okay? All right, so that is there. Maybe we should pay a little attention to that. And then we made the what? Higher high. All right, so we're making that higher high here, and we're not even there. Maybe that's something else we should pay attention to. That's a possibility as well. But when we really look at this is where my head is with it. Here is our neutral line. This 50 right here is neutral. Here's where we're oversold on a 4-hour chart. This is what I got out of it. I'm not even at 4,200. And I'm already at a point where I'm neutral. That is really bothersome. That I couldn't even stomach something like this to here to here. So let me explain to you why this is so significant. When you're here and then you go to that level at the top, okay? So you're here and then you're rallying. All right, so look at this kind of move that you got out of this. You got about a 4.5% move on the market last time. What are we getting so far out of this low? We got 1.5%. So I'm not even anywhere near on track for where we were before. That's troubling to me. That means that we're seeing issues across the board. And we know this already. Now, if we take a look at the NQ on the 4-hour, similar, where you have this positive divergence, which of course I like positive divergences. You had one here on the 4-hour, but all we got out of it was this little bounce. So that is somewhat troubling. Here, take a look at this on the hourly. Does it feel like you're approaching overbought on the Nasdaq already on the hourly chart? And then you come here and look at this and you drop this in, and some of these earnings we're going to have to really dig into here. But some of these earnings we're definitely going to have to dig into, but look at these levels already. Now, even if we just lift it up and just came right to that 14.5. So this is really very troubling to me that this is all we could muster out of it. If we look last time when we rallied, we were significantly higher. So these are things that really are, I won't say keeping me up at night, but they're certainly things that I'm looking at. And you may say, well, on the daily, we're still oversold. Yeah, but we could stay down here for a very long period of time. If you looked before, we were down here for a very long period of time, and it only got worse as it went on. So we don't, just because you're down here on the daily doesn't mean you're going to bounce. You're going to have to go hourly, 4-hour, and then kind of work your way through it. That's what we're doing here right now. Now, I don't want to make this video too long because it is on a weekday. But a couple things. Number one, please share this video, even if not on social media. Please share it when you're at, I guess if people still go to the water cooler, wherever. There is a lot in here that you need to understand. Okay, number one, the bond market right now is driving everything. The bond market is driving the dollar, and that's based upon what's going on with the yen. And we're going to talk about that a little bit today, but you're going to see information that comes out tonight when Japan has its monetary meeting about what they're going to do with rates. But we need to pay attention to this very, very closely, and we need to understand what's going on. I want to point one thing out to everybody. The ES, and this is why this is so important that you watch and understand this and what's going on in Japan. The ES, when the S&P 500 last hit its high, let's clean all that off. When we last hit our high, right here, July 27th, and that high, that's when we saw Japan come out and change their monetary policy. They are hinting at changing the monetary policy here again. Now, if it wasn't enough that we have earnings, the Fed this week, we also have Japan this evening. So this leaked, and then I want to go through the response so you can understand what the issue is. Now, this gentleman is one of the best bond experts, in my opinion, in the world. And his statement on this news is a disorderly shift in Japan's monetary policy could spark bond market contagion and increased risks of a financial accident. I personally think he's understating the issue. For those that are in the Alpha Chasers community, we walked through this today in detail. And one of the key things is just to understand how he sees it. So let's go through that, and then we're gonna dive into this a little bit more. Now, I apologize, this is from Reuters, and the way that this clipped, it doesn't come out as clearly as I would have hoped, but here it is. Japan needs to be mindful of its yield curve control. So, as we talked about in July 27th, they're taking it up 50 basis points. And then, now they're talking about taking it up 1%. That's what leaked today. I was surprised that we didn't see more of a sell-off in the market. Perhaps they think they're bluffing. We'll find out this evening. So this evening is going to be pretty interesting. A disorderly exit would create a volatility in the world's market. He's not joking, and add a risk of a financial accident. This is real. This is a problem. Now, Japan's aware of this. And the issue for Japan is Japan owns about $1 trillion worth of US debt. So they're not going to bite off their nose to spite their face. They're not going to do that. But this is going to slowly lead to pressure if it's done incorrectly. Japan's central bank should be mindful of how it ends the country's yield curve control policy. Any management could roil global markets. The Bank of Japan has used YCC, which is right up here, yield curve control policy, and they just call it YCC because it's easier. I guess maybe they sound cool, to keep yields at a specific level, put at odds with much more hawkish peers around the world that have been aggressively hiking rates. YCC has also caused extreme yen weak. Okay, so you have that distortion as well, weak yen versus the dollar, and other distortions that have raised doubts about central bankers' ability to execute a gradual phase out. But a disorderly exit shouldn't happen either, as it would be destabilizing for Japan's balance sheet. This is very true. They own a ton a ton of US debt. Again, if they do this the wrong way, they're going to have a real problem on their hands. The resulting contagion would exacerbate the instability in global markets already contending with the development of the US Treasury segment. High volatility in two of the world's most important sovereign bond markets would increase the risk of financial accidents and headwind to face global growth. Despite this, the Bank of Japan should quicken its policy exit, as increasing distortions only add the risk of forced mishandling. In other words, figure it out. Japan authorities may be close to changing policy, as a recent Nikkei reported, hinted that the government yields may be allowed to climb higher immediately after the report the yen rallied. That's why the dollar's been what? Dropping. Yen rallies, dollar drops. Okay, makes sense? Yen rallies, dollar drops. All right. Still, yen is caution that long external pressures from Japan persist, the greater the probability that foreign and domestic traders will test the central bank's ability to maintain its current monetary policy. Let me explain to you. I was getting ahead of myself there. Let me explain to you what is really important about this. The longer external pressures for Japan persist, the greater the probability that foreign and domestic traders will test the central bank's ability to maintain its current monetary policy. In other words, traders will put pressure on monetary policy. They will go after the bonds. They will go after any instrument that could force them and force their hand. The bigger the cracks that result, the likelihood that a forced mishandling, go back to the arrow, a forced mishandling of this exit has negative spillbacks to the U.S. and amplifying the bond market volatility. Now, if monetary policy, Japan's monetary policy was not enough, tomorrow night we have AMD's earnings, and we should talk about this in some detail. Now, the second most important earnings this week is going to be very clearly AMD and what that does to semis. And there's some things here that we should just be aware of. Surging demand for GPUs crowds out CPUs. Now, this is just a clip that I took out from Deutsche Bank, and they have a whole report on AI, and I'm just giving you a portion of it right now. But one side effect of the AI frenzy this year has been the surging demand of AI-suited GPUs has eaten into the budgets for more traditional CPU. So in other words, the pie didn't get bigger on the CapEx spending. What they did was they moved the pie. So in other words, they're taking from this piece and they're putting it here. This is one of the reasons why we've seen AMD be weak, and it could be a reason why AMD sells down, and you might see the AI names sell with it, but it really shouldn't be that way. And I wanted to explain this because I think people need to be aware of this before it comes out. For example, NVIDIA's data centers revenue as a percentage of their total assets has grown substantially. I'll show you this in a minute, driven by the increased investment in GPUs, whereas data center revenues at more CPU-heavy competitors, AMD, Intel, remain flat. Even so, CPU remain as necessary as ever to the current imbalance in demand is likely to reverse next year as the initial mad dash for GPUs calms down and supply normalizes. At least that's what everybody hopes. High processing with data centers remains king, while specialized parallel processing GPU units are at the forefront. NVIDIA has a commanding lead with this A100 and now with the H100, whose revenue swiftly surpassed the A100 in the second quarter after it was launched. In other words, this was their lead. This one is now better than this one, and it's now doing more in revenues than they thought. 9 times faster than the A100 AI models and 30 times faster in interference when the model applies to training new tasks. AMD remains a distant second in the GPU market. It's pinning its hopes on the indistinct MI300 chip, which will be launched this quarter, although with no meaningful revenue ramp until the second half of the year, next year. So in other words, everyone's going to be looking tomorrow for this AI news. And what Deutsche Bank is very kindly trying to point out is there's probably not going to be anything unless they are going to move and come out and say what? Second half of next year? Maybe that moves to first half of next year? That could be it. But if it stays this way, everyone's going to think AI is not a thing. The stock's going to sell down. Just be aware of what to look for tomorrow on the conference call. I'd rather try to prepare everybody ahead of this. Now, this just shows data center revenue as a percentage of sales. And it says, here you are on 22 versus 23. And you can see AMD right here at 26 to 28, Intel 30, and they're expected to lose market share. And NVIDIA went from 56% to 76% as a percentage sales. And this is by Deutsche Bank. Now, if we just take a look at the basics of AMD, we can see in here very clearly, stock has hardly moved today. And we know we're not really expecting that, but there was some news here that could have moved the stock and it just didn't. We'll address that in a moment. And here we are. This is what we're looking for tomorrow, 5.69 and 68 cents. If we just look at the basics, the most basics of indicators, we can see that we are below the 55, the 22, and the 12. That is what I use. You should use what you're comfortable with. If you look at how you're acting on the 55, you can see exactly how we're acting. We are holding here on the RSI, but any kind of news-driven event can absolutely change that and go from there. 200 is breaking right in here, and this is setting up for what we kindly refer to very warm and fuzzily as a death cross. So we're going to want to see what happens here. We definitely do not want the 55 to cross the 200. If we just take a look here, we're going to be able to see these numbers and how they move. You're about $5 across, and then you go out about 5 days later, and you can see that you're about $4 away. So I would say every 4 days, 3 days, you're losing about $1. So unless this gets over 104, which would be on earnings, in the next 2 weeks, you probably have a death cross here, which is not what you want to see going into NVIDIA for sure. But it's not what anybody wants to see. So be aware of that. Now, this could have easily sold down today on semi. It was basically a dumpster fire. Actually, it was an embarrassment, the dumpster fire is the way it acted. It just opened and it was just straight down. I had too many others that we were trading and shorting off the open, but this one was just an absolute disaster, and just ever since the report just completely collapsed, and you can just see how we acted, coming in at 83, closing at 63, not exactly what you want to see. Now that could have given AMD plenty of reason to sell down, but it didn't. And a lot of these names really didn't sell down on it. Now, we're gonna have to see how this keeps playing down, because if you keep poking, eventually something's gonna break. This evening, LSCC's out, and here's our death cross. We were just talking about those. That's certainly not something that should make you feel great going into earnings, but they came out okay, but they didn't really ramp up the way that people were expecting. So what are we seeing? So we're seeing selling in the space where we have Wolf. Wolf came out and is a complete, really been selling down pretty handily here. But what is it doing? It's trying to rally here. It's trying to rally into the end of the day or into the after hours. You're trying to rally about three points right now. And you had a fairly decent quarter. We'll have to see how that call goes. So this might put pressure, keyword, might put pressure on them tomorrow. We're going to have to see how that plays out. As far as I'm concerned, looking at NVIDIA, all we did was the same, two-step that we've been doing, where we're looking like we're going to break, and then they don't break us, and then they lift us up. And this is what we've been dealing with. There's nothing wrong with it. I mean, it is what it is, but you can't be going out there and saying, this feels like something that we should be buying. Certainly not with where we are in the indexes, what's going on with the war, and where we are with Japan, their bond market. There's a lot of what ifs here right now. We could what if all over ourselves, candidly. So we have to watch this level, be extremely cognizant of anything in this level. And we always have to look at, are we taking out those lows? Well, we kept starting some pressure, and then we rallied, but it certainly didn't get out of its own way. All it did was frustrate sellers today and perform like this. So as far as on the semi front, we're really going to want to watch this. Now, if we get into solar, and I think we should get into solar, we have names like JKS, which absolutely crushed where they needed to be. And if we look at that crush, look at that. I mean, that's a crush. And this is all we got out of it. So I couldn't even close over the 55. So again, you would think it would give you some relief. It didn't give you any relief. You had ENPH make a lower low. SEDG finally comes out with earnings this week, and that even made a lower low. Even after the pre-announcement, we're going lower. This is somewhat troubling. If we take a look at TAN, we're still trying to hold on here. I mean, I have to actually zoom up so I can include this in the graph. So I think that's troubling. Now, what I do like, let's point out something that I do like that we're seeing on. We got right and touched 55. Look at how we closed. Not over it, but on it. So we're going to want to watch this tomorrow and see if we can get our first close over it since we broke. I use a 55 here, not a 50. You should use what you're comfortable with. So that was a really interesting spot to stop, and we made a higher high today. This is the exact opposite of what Tesla did, but before we go there, look at Netflix. Netflix got to the 55 off the open and did nothing but see buyers all day. So we are seeing pockets, or let me rephrase that. We are seeing attempts of pockets of strength right now. We're seeing some really good earnings after hours in some of these names where you're seeing pins absolutely crushing it, raising revenue guidance, talking about lower costs, stocks up $3 after hours. That looks great. But at the same time, we're starting to see the towel kind of thrown in here on a couple of these names. For example, Tesla, we were waiting to see if we were finally going to break, and we did. After earnings, you're down about 50 points. That's not a small move. And I have to say, you're not seeing any signs of this holding at all. Zero signs. Even when we were rallying today, this was one in the community that we actually were shorting. And I got a lot of comments about the live trades and showing the live trades. So I'll make a habit of showing you the live trades I do in the community. I get asked a lot about that, showing the live trades. I'd rather show the live trades than show my trade. I think that's kind of just silly. Just my opinion of it. But you can always comment on it as well. But see how you acted. This was just so obvious. And all you had to do today was just read the room, man. Like, not my room, but just read the room. Like, very simple VWAP. As soon as you broke VWAP, up, boom, reversal, that was it. You know the 200s right here. You know what you're dealing with. So when you start to look at this, it was just, this stuff was glaring. You look at where you're at, and there's just absolutely no reason to think this has any chance of holding there. And it didn't. So it is what it is. It never looked back. What would scare me if I was a long-term shareholder here, the number one thing that would bother me as a long-term shareholder is the fact that I couldn't even get to VWAP. That's how much selling was in here. That even with all these little fake rallies we have in tech, this couldn't even get up. And that's a problem. That's a real issue. So, you can't trade at 50 times earnings if you're going to do this. If your revenues are going to be the same and your earnings are going to be roughly $1, you're at 50 times earnings. So you either revolutionize something else, or you're going to probably trade at 20, 25 times earnings, and people aren't going to like where that puts the stock or that comment, I'm sure, for those that are like, Tesla fanboys. But it's what it is. If you take the growth out, you take the E and you lower the E, the PE will contract. I mean, it's really that simple. So I don't really like how this is acting. I think if we take a look at the SOX, I don't think anybody should be looking at the SOX and feeling really warm and fuzzy about this market. I mean, that does not look like something that is just going to just miraculously revert. And you have a lot of pressure out there. Now, let's take a look very quickly. I got a lot of comments on Saturday's video and what's going on with the underlying sectors. And I just want to comment on this. You should really use what I showed you on Saturday. You can do exceptionally well with what I showed you on Saturday. And it's something that I would be paying attention to, sure. But just to go through these levels, stocks below the 5-day. Yeah, you're not even at a level yet where, now it might go lower later when they come in, because just note this is still from Friday, but we're not really at a level yet where these are really dropping to a washed out level. We talked about this a little bit. I thought it was worth going over again. So we really want to watch that. We really want to see how it goes. You start looking at put call ratio on equities. Are we anywhere? Are we anywhere that even shows anything excessive? We're not anywhere on anything like that. And you had broad-based buying in a lot of these names. The XLCs trying to make a rally here. They were the strongest. Financials are trying to make a comeback, but these are all broken. They're all below the 200, the 55. And when you start really digging into it, all we really saw was short covering. Does that look, XLB was third best sector today. Does that look like something you'd want to buy? So I would tell you that I would just sit, watch, and wait. Let the earnings play out. You have the Fed on Wednesday. You know that you have to watch what Japan does overnight and how that affects tomorrow morning. You have a lot of moving parts here, and I would take that into account. The best thing that we did was when we traded today was just get out of the way after we made money. And that was it. That was the first hour of the day. That's really where the profit was today. We didn't even have a big rally into the close or a sell-off into the close. This was something that we shorted in the room. Again, very simple strategies are working the best right now. I'm just going to be very blunt about this. You break VWAP, you're done. Okay, it's really clear. This broke VWAP, and it was just an absolute clear shot straight back to a gap fill, and we did exceptionally well with this trade today. I would tell you that would be where my interest would be. I would also tell you that you are still losing more sectors than you are gaining when you start to look at this. Take a look at the insurance names. This was an absolute dumpster fire on Friday, and now you're down another 3% today, and you're not seeing any bounce in Ford. You're seeing Ford go lower. I actually have to adjust the chart and pull it up. And then you look at GM. This was another one we shorted today, and that's not doing any well. So I think you really have to take a look at this and really understand where you're at. As far as Tesla, because I will be asked about levels tomorrow. And again, just FYI, the wait list is open now to join the community. So if you're interested in joining the community, get on the wait list, because those invitations will go out and then it's going to close for the rest of the year. But if you look at your levels right here, you've cracked. I mean, there's no doubt that you've cracked. I mean, you have to start looking at some of these gap fill levels. 180, people say, oh, it can't get there. It could be there sooner than you think if this continues. And then you start looking at some of these major levels that are there that held before, like 164. This is very achievable if this gets worse. And I don't foresee anything that's going to rally us except earnings. And right now, we're not seeing any sector come out with earnings that are crushing and pushing the equity markets higher. That's it.